Welcome to the Deep Dive, the shortcut you need to being the most informed person in the room.
Great to be diving in again.
Today, we're really cutting to the heart of some high-stakes strategic decisions. We've got three companies all facing, well, a version of the same tough choice.
Yeah, it boils down to this. Growth comes knocking, maybe disruption too. What do you do? Do you scale up fast? Do you break the company apart?
Or do you double down on what makes your structure unique, even if it limits growth?
Exactly. It's this fundamental tension. The easy path looks like just grow, but often that's precisely what shatters the structure that got you there in the first place.
So we're looking at a really disruptive VC firm, Andreessen Horowitz.
Then a massive older security and logistics company, Brinks.
And finally, a craft brewer, Brooklyn Brewery, scaling up like crazy, all facing the structure versus scale question.
And they all kind of prove the same point. How you're built, your organizational design, it's either your biggest asset or, frankly, your biggest liability when things get turbulent.
Right. And we've got source materials digging into their internal debates, what critics were saying outside, market trends, the whole picture.
So we're pulling out the organizational blueprints, trying to see what makes or breaks a strategy long term.
Let's dive in. First up, Silicon Valley. Okay. Andreessen Horowitz. A16s. They launched in 2009, aiming to basically flip the venture capital model on its head.
Totally. They didn't just want to play the game, they wanted to change the rules.
Yeah.
And they moved fast, raised, what was it, $300 million right off the bat?
Yeah, and then quickly added another, $2.35 billion by early 2012. Big money. But the real story wasn't just the cash.
No, it was their organizational structure.
Okay.
It was kind of weird for a VC firm.
How so?
They just rejected that traditional artisan model, where a few partners do everything, find deals, evaluate them, help the companies.
Right, the classic VC is set up.
Instead, they built something that looked more like, I don't know, a big Hollywood talent agency or maybe an investment bank, a network model.
Powered by a huge operating team.
Huge and expensive. This team wasn't just support staff. They were specialists designed to create network effects for the portfolio companies.
And the scale, when you look at the numbers from, say, late 2013, it's pretty striking.
It really is. You had 8 general partners, the main investors,
Okay.
14 supporting investment pros, standard enough.
Then
Then you had this dedicated operating team of 43 people. 43 focused just on things like business development, technical recruiting, executive recruiting, marketing.
that's a massive overhead for a VC firm. How did they even pay for that? It must have involved a serious trade-off.
Absolutely. The general partners, Andreessen and Horowitz included, took a big hit on their cash compensation. Sometimes like only a third of what partners at other top firms were making in salary.
Wow, so where did their upside come from?
Almost entirely from carried interest, the carry, meaning they only got their big payday if the firm delivered massive profits later on. They were basically betting their own salaries on this operating team structure working.
And investing their comp back into the infrastructure.
Exactly. And that infrastructure was built like a reciprocity engine.
Okay, explain that, like the marketing team example.
Yeah, perfect example. The marketing team wouldn't just help A16's portfolio companies. They'd help journalists, PR agencies, anyone in the ecosystem, even if the story had nothing to do with an A16's company.
Sort of a no-strings-attached approach?
Pretty much. The idea was to build this huge web of goodwill and connections.
Yeah.
They expected it would pay back later in better deal flow, better reputation, reciprocity.
Makes sense. And the talent team, the recruiters, had a similar long-game focus.
Definitely. They weren't just filling jobs at startups they'd funded. Shannon Callahan, who led recruiting, focused on building relationships with maybe the top 10,000, 20,000 engineers, designers, product managers out there.
Wow, that's a lot of people.
Yeah, and they offer career advice, real high-level stuff, sometimes even recommending someone join Google or Facebook if that was the best move for them.
Even if it wasn't an A16's company.
Right. The goal was simple, almost audacious. They wanted that top engineer or designer to think, A16's helped me back then. I'll remember them when I start my own company.
Building a future pipeline of founders.
Exactly. And that whole founder-friendly thing, it wasn't just talk. They formalized it.
Like the fine for being late?
Yeah, Ben Horowitz actually mandated a $10 per minute fine payable to the entrepreneur if any A16's VC was late for a meeting.
Seriously. That sends a message.
It does. And they committed to giving entrepreneurs quick answers, especially a no. And not just no, but a specific no with clear reasons why. It was about institutionalizing respect, making culture a weapon.
Okay, so this unique, expensive, high-touch structure is working. But then comes the growth question.
Right, 2013, they're debating doubling their assets under management. Huge move.
And the big worry wasn't just finding deals for all that money.
No, the core worry was, if we get twice as big, can we possibly maintain the kind of communication, the intimacy that makes this whole network model actually work?
Because communication paths don't just scale linearly.
Exactly. The partners themselves pointed this out. The number of potential internal communication lines goes up exponentially as you add people. Double the size, and you risk collapsing the very culture, the very communication flow. That's your biggest asset.
So the scaling decision becomes really complex. Do you just pour more money into the same Silicon Valley IT startups?
Or do you dilute the focus? Do you expand geographically New York, maybe China? Do you go into completely different sectors like biotech?
Each option potentially stretches or even breaks that carefully built organizational structure.
The structure is the moat. And doubling everything, risks flooding it.
Okay, let's pivot hard now. From a disruptive network trying to scale, let's look at a legacy structure fighting to stay whole.
Yeah, we're talking about the Brinks Company, the armored car guys, back in late 2007.
And they were under serious pressure from activist investors.
Oh, yeah. Big time. MMI Investments and Pirate Capital were leading the charge. Pirate even had a seat on the board.
And what was their argument?
Pretty simple, on the surface. They argued Brinks stock, BCO, was way undervalued, trading maybe 35% below what the company was actually worth if you looked at its parts.
So their solution was?
Break it up. Specifically, a tax-free spin-off of the two main businesses. Unlock that hidden value.
Okay, so let's unpack those two businesses because they were really different, right?
Very different. First, you had the core, what we might call Brinks Classic, the armored trucks, secure cash transport, ATM services, global logistics. Right.
That's
the business everyone knows.
Big, established.
Big revenue, yeah. $2.7 billion in 2007. But the operating profit margin wasn't stellar, around 8.2%.
And it had some baggage.
It did. Legacy healthcare liabilities dragging on it from old coal operations they used to own, weighing down the valuation.
Okay, so that's part one. What was part two?
Part two was Brinks Home Security,
or
BHS. Totally different beast. Residential alarm systems monitoring, mostly in North America.
And the numbers there?
Much smaller revenue, only $484 million in 2007.
Yeah.
But look at the margin. A consistent, really impressive 24% operating profit.
Wow, okay. 8% versus 24%. You can see why the activists were interested.
Absolutely. Their argument was basically, BHS is this fantastic high-margin, high-multiple business, but it's hidden inside this larger, lower-margin conglomerate.
Hidden value.
That was the phrase. Analysts agreed. They saw BHS as the gem. MMI crunched the numbers and estimated a split-up valuation somewhere around $75 to $77 per share back in late 2006, significantly higher than where it was trading.
Okay, so the financial logic seems pretty compelling.
Yeah.
Sum of the parts is greater than the whole. Why fight it? Why would CEO Michael Dann and the management team oppose the spinoff?
Well, the counterarguments weren't really about disputing the math directly. They were focused on the risks of breaking the integrated structure.
Risks like what?
First and foremost, a brand. They argue the Brinks brand name, security, trust, reliability, was absolutely critical to the success of the home security business.
Interesting. Did they have evidence for that?
Well, analysts pointed out that BHS had a really low customer churn rate, or disconnect rate, only 6.4% in 2006. That was roughly half the churn rate of ADT, the industry leader.
Half the churn. That's significant.
Very. Management's fear was, if you separate BHS, it loses that powerful Brinks brand association and customer loyalty could evaporate. That low churn rate might disappear.
So the integrated structure provided intangible brand value. What about the financial side? Activists said BHS could fund itself.
Management pushed back hard there, too. Remember that BHS, despite its high margins, was super capital intensive.
Right, the $1,400 per installation cost.
Exactly. It burned through cash to grow. Management argued that BHS needed the big balance sheet of the parent company, BCO, to fund that growth smoothly.
And separating it would make funding harder.
Much harder, they argued. A standalone BHS would likely get a lower credit rating than BCO's solid A4 rating, which meant borrowing money would become more expensive.
Which could choke off growth, especially as BHS wanted to expand into the commercial security market.
Precisely. So management's case was, yes, maybe you get a short-term stock pop from splitting, but you sacrifice long-term financial stability and crucial brand integrity. The integrated structure wasn't just legacy, it was protective. It was necessary infrastructure.
A completely different view of structure compared to A16's. For Brinks, the existing structure was the defense. Okay, let's round out our trio with a different kind of scaling challenge. We're moving to the craft beer world, specifically Brooklyn Brewery.
Yeah, a great story. Founded back in 1987, and by 2014 they'd climbed the ranks to become the 9th largest craft brewer in the U.S., doing about $60 million in sales.
And they were smart about identity right from the start.
Oh, definitely. They got Milton Glaser, the guy who did the NY logo, to design their iconic B logo.
That's amazing. What was his advice?
He told them, lay claim to Brooklyn, own that identity, which they did.
But interestingly, they weren't actually brewing in Brooklyn initially, were they?
No, that was the tricky part. They used contract brewing upstate at FX Matt Brewing in Utica for most of their volume. They had to kind of finesse that awkward marketing issue, as they called it.
And distribution was another early hurdle they had to overcome structurally.
Right. Back then, the big regional distributors just ignored tiny craft brewers.
Yeah.
So Brooklyn Brewery had to basically invent its own distribution arm, the Craft Brewers Guild, just to get their beer onto shelves and taps. Structure born out of necessity.
So they built this authentic brand, found workarounds for production and distribution. But by 2015, the market got really tough.
Yeah, they were caught in what you could call a pincer movement, a strategic squeeze.
Okay, what were the two sides of the pincer?
On one side, you had the giants, AB InBev, Miller Coors, the big industrial brewers. They started buying up successful local craft brands like Goose Island in Chicago.
Creating crafty beers.
Exactly. And they'd immediately pour massive advertising dollars into them. Miller Coors was spending almost $19 million a year just advertising Blue Moon alone. Huge budgets.
Okay, so pressure from the giants. What was the other side?
Intense local saturation. The craft beer boom was kind of peaking. In 2014 alone, something like 456 new microbreweries opened. That's more than one per day.
Wow. So fierce competition everywhere. Big guys getting bigger, tiny guys popping up constantly.
Right. The market was consolidating at the top and fragmenting like crazy at the bottom. A really tough spot to be in the middle, even as a successful brand like Brooklyn.
And complicating all this was a shift in the consumer, especially younger drinkers.
Huge shift. Our sources really highlight this. Millennials, say the 21 to 27 crowd back then, didn't just see craft beer as a drink. It was a lifestyle choice.
And they were wary of big advertising.
Very suspicious, apparently.
Yeah.
Especially those big, slick Super Bowl-style ads. Authenticity mattered more. And get this fact is just mind-blowing.
What is it?
44% of that key millennial age group had never tasted a Budweiser.
44%. Never.
Never. That's a cultural earthquake for the beer industry. It completely changes the rules of engagement.
So authenticity is king. But Brooklyn Brewery still had a structural problem, right, with production.
Yeah, that contract brewing setup was becoming a major issue. By 2014, 80% of their beer was still being made up in Utica. Their Brooklyn facility was mostly for small batch, high-end specialty stuff.
And outsourcing production has downsides.
Big downsides. Less control over quality and timing, sure, but the logistics costs were becoming brutal.
How brutal.
Shipping a container of beer from Utica down to New York City cost about $775.
Huh.
But shipping that same container to the Southeast, up to $1,850.
Ouch. That eats into margins fast. They're basically running a huge logistics operation tied to manufacturing they don't fully control.
Precisely. So this brings us to their big strategic choices in 2015. It all came down to structure and investment.
Choice number one. Do we finally bite the bullet and invest potentially huge amounts of capital to build our own big new brewery?
Right. Bring production in-house, get control, slash those shipping costs.
Yeah.
But it's a massive financial commitment.
Or choice two. Where do we focus expansion? Keep pushing in the crowded U.S. market.
Or maybe prioritize international. Markets like Sweden and Norway were proving really receptive, even more adventurous than U.S. drinkers, trying both their core lager and the specialty beers. Less saturated, maybe.
Okay, production and market focus. What else?
How do they reach the consumer? Do they abandon their grassroots, authentic vibe and start spending big on traditional TV ads, trying to compete with Boston Beer Company, which is dropping $38 million a year on ads?
Mimic the big guys.
Or do they double down on the local experience? Should they invest in opening their own retail spots like beer halls to control the brand experience directly, even though they'd had a retail partnership fail in the past?
So many structural choices. Build versus contract, domestic versus international, mass advertising versus owned retail, all while trying desperately to scale without losing that authentic Brooklyn soul that got them there.
It's the classic craft brewer's dilemma, amplified by their size and success. How do you get efficient and big, but stay small and real? #tag Hapricot Art Outro.
So three very different companies, three very different industries: venture capital, security logistics, craft beer. But underneath it all, you really see this same fundamental tension playing out.
Yeah, it's the constant battle between the unique organizational structure that creates your initial success and the often crushing demands of trying to scale that success up.
With A16s, their structure is the competitive advantage, that huge, expensive operating team, the network effects. But scaling it risks breaking the very communication and culture it relies on. It could collapse under its own weight.
Right. Then you have Brinks, almost the mirror image. Investors were screaming, break it apart, unlock the value.
But management dug in, arguing that the integrated structure wasn't a bug, it was a feature. It protected the brand, provided financial stability for the high growth piece. It was essential infrastructure.
And Brooklyn Brewery, caught in that pincer. Their authentic brand is gold, but their production and distribution structure is straining. Do they build a whole new foundation for manufacturing control to get efficient?
Or is their edge better protected by focusing overseas, maybe keeping the contract structure for a while longer, avoiding the hyper-competitive U.S. market and massive capital outlay?
It really comes back to that question the A16Z partners were asking themselves. What breaks if you double everything?
That's the core lesson, isn't it? Organizational structure, whether it's a network team, a corporate conglomerate, or a production partnership, it's never just lines on an org chart.
Not at all. It's the fundamental plumbing. It either accelerates your strategy or it becomes the bottleneck, the thing you're constantly fighting against.
So for you, the informed listener, the takeaway is to constantly look at your own situation or the companies you follow and ask, is the structure built for the goal you're actually chasing?
Or is that structure maybe the very thing that brought past success, now holding you back? Often the smartest strategic path isn't just about finding growth. It's about finding growth that your unique organizational architecture can actually sustain without shattering. It's about protecting the core engine.